this is problem 8-6. This is the B version. The one in your homework is the A version, so it should be very similar. Let's just start the problem. On January 1st, 2014, Alter Company had accounts receivable of $154,000. Notes receivable occurred. And then it gives us a bunch of transactions, and then the instructions are to journalize the transactions. So that's all we have to do. Sounds easy, right? If it were easy, we wouldn't do a recorded version of the problem. But I bet you guys will get this one. All right, so let's just take a look at each of the transactions. On January 5th, they sold $10,000 of merchandise to Flynn Company of terms net 15. So the way we do this is when I'm just going to go ahead and do the journal entry here, January 15th. So typically, most companies, what they do, and the way we're doing it here is we just record the transaction when it occurs, and then if the Flynn Company decides to take any discounts or anything like that, then we'll record those separately. This one's net 15, so we're not even offering a discount. So we're just going to record that as accounts receivable. And I think they want us to go ahead and record the subsidiary ledger, which just means record who each transaction is with. Okay, now I'm having a hard time. In a real company, you have what's called a subsidiary ledger. So with your accounts receivable ledger, then you're going to have that further broken down into accounts receivable by each different customer. All right, so that's $10,000. And then that's going to be sales revenue of $10,000. So there's our first one. I'm going to go ahead and format that. I still got that wrong on the date, didn't I? January 15th. All right. Let's take a look at the second transaction. On January 20th, we accepted Flynn Company's $10,000 3-month 6% note for the balance due. So it looks like Flynn wasn't able to pay us within the terms of net 15. So now they want to make a note. Sorry, this keeps popping up for some reason. Anyway, so they want to make a note for the balance due. In other words, they can't pay us, so they're offering to pay us within 3 months. So on February 20th, or I'm sorry, January 20th, I really do have these dates screwed up, don't I? Because that first one was January 5th. All right. So if they are going to write us a note, our asset notes receivable increases or is debited by $10,000, and our asset accounts receivable, in fact, I'm going to do this to save myself a little trouble. Our asset accounts receivable is going to decrease or be credited by $10,000. Really all we're doing is paying off, well, they're paying off, Flynn is paying off the amount they owed us by writing us a note because they don't have the cash to pay us yet. On February 18th, we sold $4,000 of merchandise to Mink Company and accepted Mink's $4,000 6-month 8% note payable for the amount due. So we're going to record that as a note receivable. Tell them I'm having a hard time typing today, 4,000. And we're going to record that as sales revenue. All right, on the 20th of April, collected the Flynn Company's note in full. So here's where we have to start figuring out interest. So let's see. What's going to happen when we collect a note is our cash is going to increase, right? And our note receivable is going to decrease. And we're going to collect some interest revenue. So those are the three things that are going to happen when we collect on a note. The cash will go up by the amount of the note and any interest that we earn. So the note part is easy, okay? The note is just the amount that's owed to us, and that was $10,000. The interest we have to figure out. So if this was a 3-month, 6% note, then we're going to figure that out. Remember that we figure things like this out by principal times rate times time. So principal, rate, and time. So the principal on the note, or the face amount, is $10,000. The rate was 6%. And the time we always express in years because the rate is an annualized rate. So if it's a 3-month note, then this is going to be 3 over 12, or 0.25. So the amount of interest that's going to be owed to us is the principal times the rate times the time, or $150. So our interest revenue is going to be $150. So the amount of cash we collected then is equal to the notes receivable plus the interest revenue, or $10,150. Whoops, 150. All right, on April 30th, we received payment in full from the Hartwig Company on the amount due. So 30 April. Again, our cash will go up. Our notes receivable will go down. And our interest revenue will go up. Again, the notes receivable is easy. That's the amount owed to us. Let's see, how much did Hartwig owe us? That's up at the top, right? On January 1st, Alter Company had accounts receivable of $154,000, notes receivable of $12,000, and allowance for doubtful accounts of $13,200. The note receivable is from Hartwig Company. It is a 4-month, 9% note dated December 31st, 2013. Alter Company prepares financial statements annually. During the year, the following selected transactions occurred. Okay, so it's a 4% note. So we know that the face amount is $12,000. And we know that it's a 4-month note at 9%. So we can do our principal of $12,000 times our rate of 9% times our time, which is 4 months out of 12, or 0.33333. Principal times the rate times the time gives us $360. And our cash will be the sum of our notes receivable and our interest revenue, $12,360. Okay, on May 25th, we accepted Creech Inc.'s $9,000 6-month 4% note in settlement of a past due balance on account. So this is going to look very much like the 20 January transaction. Our notes receivable go up by $9,000. And our accounts receivable for Creech will go down by $9,000. Remember, again, this is just a company who can't pay us what they owe us, so they're writing a longer-term note to improve their terms so that they can pay going forward. On August 18th, they received payment in full from the Mink Company on a note due. And so the Mink Company owed us $4,000 from February 18th. So we're going to do, our cash will go up. Our notes receivable will go down because they're paying it off. And our interest revenue will go up. Just like the 20 April and 30 April transactions. Again, I find it easiest to record the notes receivable first. That's $4,000. Second, to figure out the amount of interest that they owe using principal times rate times time. $4,000 in principal. Interest rate was 8%. And time, excuse me, time is 6 months. So 6 out of 12, 4.5. That equals the principal times the rate times the time, or $160 in interest. And so the cash is the sum of the two, $41.60. All right, finally we have our September 1st transaction. Sold $5,000 in merchandise to Glazer Company and accepted a $5,000 6-month 6% note for the amount due. Again, this would be just like our January 5th transaction. So we're going to record accounts receivable in Glazer, and that will be $5,000. Oh, I'm sorry, was it an account or a note? Oh, it was a note receivable, sorry. So that's a note receivable. And then we'll record the sales revenue. And that's it. So that's the whole problem. I think you can do this. The hardest part is knowing how to calculate the interest, which is principal times rate times time. Just recognize always that cash goes up by the amount of the receivable and the interest revenue that is earned when we're collecting on a note. And recognize that when somebody can't pay, they often will create a note to pay for the amount of the account receivable. So then it's just kind of trading the assets. We're getting rid of the account receivable asset and creating a note receivable asset. If you have any questions, as always, give me a call.